Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hello, everybody. Welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric Susi.
It's Tuesday, August 23rd, 2022, episode 26.
Number 26.
Hope everybody's doing well.
Yeah, likewise.
Yeah.
You too? You everybody good?
Yeah, back to school time, right?
Oh, yeah. Oh, boy.
That's always fun, you know. Yeah.
Daughters are freshmen in high school, my oldest.
Yeah, eighth grade and freshman in college.
Yeah.
So starting those tuition payments.
Oh, yeah. Oh, yeah. What fun.
That's right. That's interesting times for sure.
Meet
but
the teachers, all that good stuff last night.
Yeah.
My fourth grader, Sophia. So yeah, it's all good.
Yeah. So since our last episode, you had a fun trip, didn't you?
A little bit of a bucket list. So I was grateful to be able to participate. So this new, it's called Strive Asset Management. It's a fund firm here in Dublin, Ohio. So they're based in Bridge Park. They have an office location, and great bunch of folks. Been following them for a few months, and we had an invitation from them. To be on the closing bell. So we're on the New York Stock Exchange. You know, Andy should have gone, but he had an anniversary. So Eric Biddle, he came in on board with me. So Eric and I went. It was great, good experience. My little bucket list. So awesome, fast pace. Sort of what, just a quick little thing about the exchange going up 80s, 90s, following it all. There are 5 different components of the exchange. Now it's really just one area, whereas market makers are the folks behind it. So I got an in-depth talk to some market makers just to sort of see how it works. GST is a big one that's there, but it's pretty cool.
Yeah, good.
Insider stuff.
Did you get to say the line, the Blue Horseshoe?
Blue Horseshoe loves Anacott Steel.
Loves Anacott Steel. You got it. That was my T-shirt. I love it.
Little Wall Street reference.
Wall Street. There you go. Good. But we missed you. But thanks. Yeah, it was fun. It was cool.
Yeah, good.
Yeah, and speaking of that fund, I mean, we are using it, right?
We're going to start. Yeah, we're going to probably be rebalancing. Probably here in September.
Yep.
But starting to ease it in some accounts already.
Correct.
So so it's a great way to get some energy exposure. As energy did well at the beginning of the year, and it kind of pulled back, and it's kind of a good entry point for that, and probably over the next 12 months or so.
I would think so.
So as energy prices go up,
which is what we anticipate.
Yeah.
And they're printing money, cash cow. So that's a way to you want to, with what's coming, more volatility and back and forth here and there for the next 6-9 months, a year. Go with companies that can deliver dividends, earnings,
sure,
beat the numbers, and at least meet them. So that's why we're camping out there. So that's good.
Yeah, look forward to using that.
Yeah,
that's good. So what else?
Well, let's maybe touch about the tracker there. So
what's been going on?
A little bit of spending, a little bit of wage growth / inflation. So things are still. Yeah. At the airport, there are plenty of people still flying when I was out flying around. So.
That's right. Yeah, I don't know we took a trip. My wife and I, we had our 25th wedding anniversary. So we went down to South Carolina, and people everywhere. It's like, you would not think that we're either in a recession or on the verge of a recession.
Yep.
And people are, there were lines at restaurants, there were lines at activities. And it's almost like people were so pent up that they don't care what the cost is, right? They just want to spend money and go have fun and enjoy their lives, I guess, to a certain extent. But I
believe that's why Brian Westbury from First Trust says this year, not yet, next year. So I think to your point, I think it's coming. So
it could be.
Yeah. We'll see.
Yeah, but jobless claims still, pretty low overall,
Yeah,
right? Unemployment rate still low.
Yep.
Retail sales up slightly, jobless claims, all that. So things look decent.
Yeah, and that's where he was talking about from First Trust. Things are distorted somewhat. So certain things are good, certain things are not good. You blend it all together, it's sort of like mush.
Yeah.
So it is what it is. 2 steps forward, 1 step back. So that's where we are in the economy and also the stock market right now. So I think we've had our the first 6 months were bad. June 16th with the lows. We had a 2-month relief rally, bear market relief rally, and we anticipate a little bit more of a pullback. Will we retest the lows of June 16th? I don't know if we'll go that far, but we're going to go lower is what I anticipate and what we're following our research center folks that we follow. And it's part of it, the ebb and flow, and then hopefully we get our November kick-in rally, and then the pause, which we'll talk about, I guess. So we want to get into what the Fed's going to be doing the next 3 rates. So there's going to be a meeting here next month, September. Then there will be one in September, November, and then December. So November, let's start with the order. So September next month. So I think we both agree 50 basis points.
Yeah.
Yeah, maybe 75. I doubt it. It's probably just 50. Then the big one there is November. So the election midterms will happen after the Fed meeting. So that will occur. I'm thinking they'll go down to 25. So what are you thinking?
I think September, and then that's it. I think the Fed will pause. The market will rally.
Okay.
I think the market will rally into September, early November in the election. The Fed pauses, and then we're in the next year.
Okay. So, and we'll see. And that's where we're having this nice little debate, I guess. Yeah. So, I'm saying 50, then I think 25 in November, then the pause comes in December.
Okay.
So I'm thinking more of a Santa Claus year-end rally myself. But we'll see. I mean, it's just that information as we get information coming in. Nobody knows. This is just our best guess with the information that we have at this time. Yeah.
Yeah.
So that's that.
Yeah, good.
But there's been a lot out there going on there. So I guess they got through the IRA, the Inflation Reduction Act. Excuse me, Build Back Better, repackaged. Anyways, so of the maybe 2 good things that are in there, maybe I'll be generous. But with that said, again, M2 more printing. It's just whatever.
Sure. 700
billion, 1 trillion. Throw out a number. It's just unnecessary. Unfortunately, didn't get targeted to exactly who needs it. But,
sure, never does.
Never does. It is what it is. So security, COLA. So what are we hearing on that now?
Yeah, as low as 10, 12%.
Yeah, somewhere in that range.
12.
Right.
Yeah, which would be great.
We'll firm that up, I think, in October, right? We'll fine tune it when they get the final number out. But with CPI number running hot, and, it has peaked, going lower now. But the point is, it's still going to be elevated and sticky for a while.
For a while, yeah, that's right.
So
I agree with that.
Yeah, we have that, and then along with, I guess, what's coming from after the IRA, Inflation Reduction Act, and student loan forgiveness. So here we go. So that's all part of the politics. So he's been following that. So, there's a reason why it ends here at the end of August, the forgiveness. So there'll be an announcement here at the end of the week or next week. Right?
Yep, that's right. Yeah, he said, they said by the end of August. Yeah. That was their goal.
Right.
So, yeah. We'll see.
We'll see. If everything's wiped off, only 10,000 or a mixture between. But I think I saw 74% of the population does not want it
benefits the wealthy. That's who it benefits. Yeah, right. So it's like, you know what they say though, the common men make life possible. Aristocrats make life fun. So
I like that. The scholar elderly man.
Yeah, that's right. I heard that. I heard that somewhere.
That's good. Cool. So more to come on that, but I wanted you to be aware of what's coming. We talked about the energy, natural gas and oil. So just a few things in historical pattern. I track everything daily on charts, and non-emotionally I can view things. So natural gas yesterday, highest all year to date, up 166% year to date. Natty gas, 9 spot. I forget, like 7.5 or somewhere in that range. So, strong dollar, dollars up over 13% year to date. So just think for in cash all year, up 13%.
It's crazy.
Yeah.
Crazy. So what's the forecast going to be? Is it anticipated to be a cold winter? Do we know?
Well,
I mean, I know they always throw it out.
They always throw it out. Yeah, I mean, yes. I mean, that's what we hear. And I guess to your point, I thought I heard something, you mentioned abroad. What's Europe doing over there?
Yeah, Germany, they're telling citizens they're collecting firewood. And they're setting up call them these burning stations where basically it's like a barrel of
firewood for heat.
Because they're obviously very dependent on Russia, and Russia's kind of the sanctions haven't. Yeah. And I think I read somewhere actually Russia. They're making more money off energy now than they were pre-war. So
correct.
The EU hasn't. They're not serious.
It's corrupt, and they got a lot of issues over there. So whole World Economic Forum, WHO, all that stuff. It's all part of the snake, the head of the snake. So, Fed rates, we talked about that, new home sales, we'll get into that, but things are, obviously cooling. It's all part of the plan. As Fed raises rates, they want things to cool, to get the inflation rate down, the core CPE to get that down, et cetera. So, unfortunately, it's still going to be sticky. Yes, inflation CPI print has peaked 9, 8, and it'll be elevated, but going lower, 8, 7, 6 for the rest of this year.
Sure.
But it is what it is. I guess in regards to, repos. So repos, I was on a call.
Car repos, right?
Car repos, yes. Very good. Not house repos, repossessions of the house. So it's car repos. So during the, printing money, all the stimulus, free check money that was being delivered the past 2 years, people went out and got luxury cars. So when they did that, there was a gentleman on a call. What he does is in charge of repos. It's all coming back. This is going to be the next biggest thing since 2008 repos, he said. So they're already being a tick higher, elevated for repos. And banks are already, instead of, remember the 4-year term, 5-year term? For mortgage, Oh, okay, 72, 84 month. Yeah. The banks see the trajectory of what's going on in the car market. It's a free-for-all. It's not really as regulated as homes per se. So, coming from the call I was on, and what they're saying is, okay, the banks see this trend and they see it tick up. So on a monthly / quarterly basis, they reproject their numbers on car loans and to get softer or more stringent on their lending abilities. So right now they're reeling it in, bringing in the 84 month, 72 month down to 5 years. It's like, okay, so they know what's coming, and it's already started to elevate. So that's just part of it. All part of the whole picture of getting things to slow down, getting back to a normal reality type of an economy. And
it's crazy. I'll keep my 2007 Honda Odyssey minivan.
Yes, we're keeping our cars too. We've had that discussion. We just maintain it and drive it until it doesn't drive. So
that's right.
Yeah, I mean, and we talked about this. I mean, with this new EV stuff going on. Okay, great, folks. With the IRA bill that was passed. Okay, there's a credit of $7,500 going towards certain cars, and Ford and other vehicle makers increased their car prices by $7,500. Just like,
So then the battery life on those is. So what happens when, like, is there going to be a used car market for EV cars when it's like, I'm going to buy this car and the battery goes dead, and so everybody's got these cars, they got to pay 10, 12, 13,000 to have a new battery put in it. Like, so
you bring up a very good point.
How's that going to work?
Prager University, so I don't want to plug them, but I'm plugging them. So Prager University, great 5-minute snapshot videos. So anybody wants to go out there, prageru.com. It's phenomenal. So they have a whole thing on that, wind, solar, battery, all the cars, and all the, they're going to be recycling and extracting some of the minerals out of the battery. But then all the other excess parts will then go to the junkyard. So the waste, they had a scale going, it's just going to implode over the next, it is what it is. Yeah. And then where you have to go get them, where are you getting them from? Brazil, China, India, all the places that, that's where the forced labor on, child labor, quite frankly. Yeah. So there's pluses and minuses. And again, we talked about this. China had 43 coal mines open last year. We shut down everything here. We shut down our nuclear. Nuclear is the cleanest. We have to have nuclear, folks, along with everything else. You just can't cut off and be quote unquote neutered, all of a sudden you have to just phase things in on time. You have to have it all. So it's a shame, but that's part of what's going on. Let's see. So I guess maybe tips of the month. What are we hearing on a couple tips of the month things?
Yeah, so we're still back to the with inflation being high. Yeah, we have the I bonds.
Yes, I bonds still. Yeah.
So I think the latest read was just under 10%.
Correct. Just under 10.
So it's so if you have if cash sitting around $10,000 per person, you go treasurydirect.gov. You can set up an account online. You have to do it all electronically. Unfortunately, you can't do it through us. You can't go to the bank. You used to go to the bank and buy bonds, save bonds. You can't do that. So, but the term on it is, I think it's a 30-year term. But if you hold it, I think it's under 3 to 5 years. There's you get past the penalty.
Past penalty.
So,
Correct.
however, but if you only hold it, let's just say you held it for 13, 14 months and say, hey, I'm going to get the cash. You pay the penalty is I think it's 3 months interest. But even if you did that, you're still going to come out ahead, even just by paying the penalty. So even if you went into it with a shorter term mindset,
better than CD rates.
You still come out,
2-year CDs. Why lock it in? So
that's right. Yeah. Too, and something speaking of with rates going up with so Schwab. This was welcome news. So they have a money. A lot of people ask about money market funds. Well, Schwab came out. Their Value Advantage Fund is paying 2.14%. So we're starting to kind of put that in the portfolios to help with some of the cash that we have sitting there too. So we'll probably be using it. For the
foreseeable future, as they finally caught up as rates went higher, then Schwab raised their rates. So now we use it in the past, the fund that Schwab had years ago, and now rates were so low we didn't use it. And now they're coming back up, so we're going to start reusing and introduce it again. So I hear you.
Yeah, I remember when I had started my own Schwab account. This was years ago. Their high yield investor checking account was paying 8%.
8% checking.
8%.
The good old days. No, I hear you. All right. Well, I guess let's go through the charts. Those are some of the tips of the month, but let's sort of end on charts.
Okay.
So a lot of information. The M2 money supply is printing up again. So now that they passed that, that creates inflation. So it's going to be unfortunately longer. Now the question is, how deep and how long will this bear market / recession really turn into be? So with that said, there we go. You've seen a lot of these before, but these are refreshed through yesterday's closing prices and or whatever the stock information is, chart information is. So pullbacks, remember, the average is 4.6 times per year. They have a 5% pullback in the S&P. Again, still at 7, but we'll see if that goes to 8 here soon. And the volatility, the VIX, remember, 30 days, Chicago Board of Exchange, the volatility index, meaning what the stock markets think going out 30 days. So the average is 18.5. We were in the chop bucket. So the chop bucket's between 20 and 30. That's what we've been in for the past month and a half. Up, down, volatility. We hit just slightly below 20 for like 2 days. I was tracking it. Now we're back up. We're at 23 yesterday. So I expect more chop bucket, the VIX volatility between 20 and 30. That just means sideways, back and forth. If things get really bad, like they were the first half of the year, you'll see the VIX over 30. If it gets over 30, it's called the F bucket. We'll leave it at that. Nobody makes money. So we'll see if we head down that path. The interest rates, 2-year, 10-year. So again, I track it. Everything's inverted. The 3-month is up over 4,000%. Started the year at 0.06 for the 3-month. Now it's at 2.76, I believe. And I updated it last night. It's going by memory. And up well over 4,000%. Now, again, the 2-year, 10-year, it's inverted. The 2-year is producing more yield than the 10-year and the 30-year as well. So it's just been all inverted. So when things are inverted, that's a leading indicator that, yes, you'll head into a recession, typically within 9 months to a year. So that's been happening constantly now. I have it all coded in yellow for the past few weeks here. So that's you see that. Yield curve steepness, again, at the inversion's 0.29. It's the difference between the 2-year and 10-year. So the difference is 0.29. And like I said, when it inverts, typically leads into a recession. The Federal Reserve balance sheet. So this is big. So it's it used to be $9 trillion. So it's $8.8 trillion. So the biggie is here in September. So as the Fed starts to, rate increase, we'll see about the November one and December. But as the Fed starts to stop or taper off the Fed increases, don't forget about the balance sheet. So that's 90 trillion or whatever. It's a billion or trillion. I'm sorry, I forget. But anyways, they're going to start that tapering of the balance sheet fully in next month in September. The past few months it's been partial, but then it gets fully introduced.
That's the printing money.
Of the buybacks. So it's the opposite.
The buybacks.
The buyback. Yeah, sorry about that. So yeah, this is the Federal Reserve, the balance sheet. They were printing money and buying back the bonds. Now they've stopped buying back and letting it roll off the balance sheet.
Got it. Okay.
So that's what that is. So that's why it started to curl over, and it's 8.8 trillion. Federal dot plot. We talked about the Fed rates. You can see here in 2022, they still want to elevate it to get over 3.375. Then next year, 2023, you can see them 3.75. It's not going to, I don't see it going that high, but what have you. You can see up and then down because we'll be reverse engines. U.S. GDP growth rate. So you can see first quarter is negative 1.6 GDP, second quarter negative 0.9, third quarter first estimate from the Federal Reserve Bank of Atlanta came out at 1.6. So 1.6 is the nowcast for the Atlanta Federal Bank there. So 1.6 is third quarter. So at least it's positive. We'll see if it stays positive.
Yep.
Jobless claims, we talked about this. Up, big spike going down. And here at 2022, you can see it going back higher. So people are starting filing for more claims. So that we anticipate that going higher as companies do more layoffs back half of the year.
Yeah, they have to.
They have to. Yeah, to hit their numbers. So there's more pain coming is what we're trying to say. CPI index, you can see it's come off latest read and 8.5, and then it's going lower. So it's come off the 9% print. Housing starts, we talked about that. This is all part of as you raise rates, housing, mortgage rates go higher, it cools and softens the economy. So that's why you see a decline in housing starts, single family and multi, you can see all those go down. Existing home sales, same thing, home sales going down. So far through July, 4,810. Average is 58.39, going back to July of 2021. So you can just sort of see that. Again, all part of the master plan to cool the economy, to oil the dollar. Mm-hmm. So you can see on the oil left axis, it's about $93 on the left through August 22nd print. So roughly 93 or so for the oil price. You remember it spiked up to 120, came back down, but we anticipate it going back up. The dollar, strong dollar, it's the right axis, so it's inverted. You can see it goes straight up this year. So dollar, it's been the highest since 2001. So I remember the euro. The euro is now yesterday. It was at the euro raised up to like $1.36, $1.40. Mm-hmm. Then it came back down this year. So the euro is down around 12%. The dollar is up over 13% this year. My point is this: it broke a dollar. It broke par, dollar for dollar, the dollar bill in the euro. So now it's 0.99, 99 cents to the dollar was the euro yesterday. Wow. Lowest since 2001. And that's big. So there's a lot of stuff happening in the fixed income market. Having worked at T. Rowe Price Fixed Income.com, late 90s, early 2000s, this is where I saw that. And I haven't seen it since then. That tells you anything. So there's a lot going on. And again, stock market bull, bear markets. Again, what we see here, more bulls and bears. That's great. However, we are in a bear market. It just depends on how deep, how long, to turn to a deep recession or not, what have you. Time will tell. And then personal savings rate, you can see there for 2 years. Woo, straight up, free money, jingle keys, buy those cars, and then boom, down. Average is 6.8%. Now it's at 5.1 and going lower. So that's where we're at. Are some charts. A little fast there, but I think it's all good.
Yeah, good.
For now. But again, we appreciate everything. Reach out to us, Andy, Eric, Russ. We're here for you, Stacy as well. So any questions or concerns you have about what's coming up, it's going to be a little more choppy, so strap in. We had a little bit of a reprieve rally here the past month and a half or so.
It's going to be good, yeah.
But, we're going to buckle in because it's not over with yet. So, unfortunately, but it's part of the stock market. With that said, I guess enjoy your upcoming fall.
Yeah,
it's our favorite time.
Yeah, that's right. Go Bucks.
Go Bucks, yep. And then take care. Stay well.
See you, everybody. Thanks.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.